Hey there, care providers. Uh, I'm going to take you on a little bit of a journey today. It's a little bit different than the regular training that I have been doing. But I wanted to tell you a story about a doctor or medical group, actually, that I have been working with to kind of give you a better picture of why I am doing what I am doing. If you feel like you are ready to grow into a medical group, to seek out investors and kind of cash out of your practice somewhat, but still keep going or whatever, something like that, exiting your practice, then you probably want to listen to what I have to say today. If you're doing that, do you feel like you're ready? Or do you feel like maybe you need some guidance in that area? If you feel like you're ready, give me a thumbs up. If you're in the comments, if you're not, give me a thumbs down in the comments. Okay, so let's get into this. I have been consulting with small businesses and have had plenty of experiences with medical related, third party payer type businesses in a number of cases. And in just about every case, I have seen some serious issues with the financial side of the business. I'm not sure why this is, but uh, there seems to be some complexity in the revenue side of the business, of course, because you're collecting from third-party payers. And I think these insurance companies make it extremely complicated to bill and track the revenue side of your business, and to track the collections, to actually know what you're going to get paid and what you're not going to get paid, and the kind of stuff that they put you through to get paid. And that's the tough piece of the business, but that is not the most part that concerns me in this situation, because I have seen how the expense side of the business is so poorly handled in so many ways. And I just want to tell you a story about this medical group. This medical group, this is one of the most interesting cases that I think I've come across. But there were three medical practices that were acquired to come into a medical group. They formed a new medical group. These investors from New York came in, promised them the world, and made it all sound like it's really easy. And then they set everything up. And if you don't know, don't know this, in Texas, and this was in Texas. And if you don't know, in Texas, if you're not a medical doctor, you cannot own a medical practice or a medical group. So these investors in Texas have to go through a administrative service agreement. That's what they call it. But it's essentially an acquisition done in such a way that it complies with Texas law. So the doctors are still partners in the group, and they're on the board of directors. And in this case, they even made them co-CEOs. First of all, I don't advise co-CEOs in any situation. Employees of a business that have co-CEOs have a schizophrenic boss, because you don't have one boss and you have two bosses telling you two different things. And that was the case in this case as well, because they did have co-CEOs. The doctors were co-CEOs. So they had like 4 CEOs in this business. Secondly, what the investors did is made things sound rosy. I believe this. I wasn't in the negotiation, so I didn't see this, but I see the fallout from the expectations that the doctors had of this situation. So I come in as a consultant, and I'm supposed to help them put together their books. Their books were all separate. They were all in QuickBooks, which is an interesting thing. That's probably one of the reasons why I got hired to do this, because I'm experienced with QuickBooks. And we're supposed to bring them all in to consolidate these. There were 3 medical groups. The way the structure worked in this, you have the 3 medical groups, and then you have a management service organization, which is going to be the organization that manages the financial aspects of the business, which means we're keeping the books and we're producing the financial statements and reporting to the board of directors every month. And the board of directors is at the holding company level. And the holding company is owned in partnership with the investors and the doctors. So the holding company has a subsidiary called the MSO, and the MSO then has a relationship with the practices as subsidiaries. So kind of give you the picture of the structure here and how that's put together. So the MSO, the practice management company, is supposed to take control of the books, began keeping all the bookkeeping and doing the financial reporting every month, tracking the revenue and managing the financial side of the business, so that the doctors can focus on their practice and focus on their medical practice and focus on their patients. That's important. But in this case, they were promised that they could keep their books. They did not have to turn their books over to the MSO. And so the doctors were taking a position. We are taking perfectly good care of our books. Our books have always been done well for us, and so we don't want anybody touching them. We'll just give you the information every month that you need to do the financial reporting. So the MSO did not have control of the books, but they hired me to come in and help them consolidate these practices so that they could report in a consolidated basis. And they took out $11 million loans on each practice to make the purchase. The investment, I guess, more appropriately the way to put it, to make this investment in these practices. And then there were significant bank loans. So the bank is going to require audited financial statements. So the first thing the bank wants is an audited financial statement of the first quarter of this group was in business. But here's what happened is that the books were all kept on a cash basis. They were not really kept. In other words, they broke all the rules of bookkeeping. Apparently what the doctors focused on was that they wanted their books only kept to the level that they can comply to taxes. They didn't want to spend any money on bookkeepers. Their office managers, their practice managers in the office were the ones that were responsible for keeping the books. And they would work with their CPA and keep the books for tax purposes. That was the sole reason why they were keeping the books. Somebody had instructed these doctors, and I don't know how common this is, but I do find it, so far in my experience, extremely common, that they kept the books solely for tax purposes and they didn't care about anything else. The management reporting didn't exist. They barely kept the books. They didn't keep all the records. You need to keep records, source documentation. So when you're doing an audit, first of all, you've got to be on an accrual basis. They were on a cash basis. And we also need to have source documentation for the transactions to justify the transactions. On the revenue side, of course, source documentation is not the same as it is on the expense side, because you've got practice management software that you're doing your billing in, and it's very complex. There's a lot of information in there. There's no single source of documentation, really, except the explanation of benefits. And all of that is managed in the practice management software. So really all of that can be handled, and according to GAAP can be handled. It doesn't have to be exact. The revenue doesn't have to be exact, because you don't know. There's a large percentage of that doesn't get collected, right? You probably know that. And I think it's somewhere around 40-50% on average of your billings don't get paid. Part of it is because of contractual agreements. I don't fully understand yet why doctors will bill knowing that it's above the contractual rate. Don't fully understand that yet, but there's a contractual rate, and that's what the insurance is going to pay if they pay. So you already have that difference of uncollectible revenue. And then there may be some claims that don't get paid. So you've got bad debt. That's another thing you have to estimate. Now, it's okay to create an allowance and make an allowance for that, so that you can have steady revenue while you're making an allowance for what's not going to get collected. And you do that by estimating based on your experience, your past experience, and funding this allowance so that you can use that allowance to fund your differences in what you collect and what you build. So that side is really pretty much taken care of by the billing software. And that's fine. We're doing fine on that piece. It's the expense side that's really the biggest concern, because I'm looking at the expense side and I'm seeing that they're not keeping the source documentation. They're not entering everything. The credit cards are not entered correctly. There's a way that you need to enter credit cards and track them like checking accounts. You need to reconcile them every month, and you need to keep the receipts and to document the transactions. And you need to, watch closely. If you watched any of my other trainings, you've heard about all this. But they're tracking their expenses on their credit cards and all in one transaction every month. And so they're not tracking the vendors, what they're spending with vendors or anything like that. It's just like paying off a credit card every month. And then they break down the expenses in that payment, one single payment. Very little documentation. You can barely even tell what the expense was for, if you can, if you can even remember what it was for. And there's some large ones on there too, for like vaccines, things that they buy from suppliers that are very expensive, $10,000-$20,000 transactions. And, obviously they've got a good relationship with the credit card company, giving them the ability to make charges of those sizes. But those get recorded and on the credit card statement as a transaction with very, very little information attached to it. So you know very, very little about it. You may not be able to tell who you bought it from, but you can't tell what you did buy. And whether or not it's something that needs to be, held in inventory. Maybe it needs to be held in inventory, or maybe it needs to be capitalized. All these kinds of things that you need to consider when you're doing books, totally ignored. And then maybe they write checks every once in a while. And so you can imagine what the financial statement looks like every month, and it can only be on a cash basis because of the way that it's paid. When they pay the credit card bill, all those expenses are booked into that month, whether they paid for it in the previous month or not, which most of the time it is in the previous month. So expenses don't match revenues at all. It's not even close. So you have to make a conversion in these acquisitions. You have to make a conversion from the cash to accrual, and going back and tracing all of that can be extremely difficult because of the nature of how little documentation is being kept in the books. So what happens ultimately to the doctors in this situation? The promise that the acquirers, the management service organization, has made to these practices is going to be very, very difficult to keep, because one, they're going to have to try to pass these audits, and in this case, the audit comes on before the CFO in this organization even begins to do a conversion to accrual basis. And he's got to get ready for an audit in a very short period of time. It has to happen in 3 months, a quarter, after the end of the quarter. So he's got 3 months to do this conversion, and also be reporting monthly, almost immediately after the acquisition, making monthly financial statements to the board that are on an accrual basis from these books, and it's consolidated into one financial statement. And these different books have vastly different charts of accounts. One of the practices has charts of accounts that have vendors as their expenses, a big long list, and also the insurance companies, each insurance company that get money from, in the revenue, they're the revenue items. So that's the chart of accounts that they put together. And of course, they're not really even looking at the balance sheet. They haven't been capitalizing anything. Everything is an expense. So when they go out and buy a $30,000 piece of equipment, they expense it. That is not acceptable for the IRS. So I'm not sure exactly what the CPA was doing on their taxes, but the way the books were kept, I don't know how he was able to do anything with the capitalization. But then the other practice here is got a different set of chart of accounts from a different point of view, also really way off standard for a chart of accounts. And you got a third one that is pretty much the same thing. And then you have payroll. They were using QuickBooks Payroll in 2 of these, which was good. That saved the payroll side. But one of them was doing payroll through ADP and did not save any payroll reports. And they would just simply take the payroll allocations for the month. Somehow they came up with a number of what the month payroll would be, and they made a journal entry for that for the entire month. And so you couldn't do payroll reporting, and you didn't have any supporting documentation except for going back to ADP and recovering it. So we're dealing with all of this stuff, and while we're also having to do monthly reporting monthly. The reporting period was the final quarter of the year before we went into the following year. So that's what was being audited. And the audit was supposed to start in April, and it was out totally out into May before we couldn't even get a trial balance out to the auditors. They can't start the audit until they've got a printout of the general ledger and they've got the trial balances for the period that they're auditing. Hadn't even gotten that out to them by the end of May. And the bank was requiring the audited financial statements by June 30th. The audit is going to take 6 to 8 weeks at best. I mean, when you're looking at 6 weeks, that is with somebody, a company that has everything together. When you have a company that doesn't have everything together, it's going to take longer because there's going to be more requests, because there's more discrepancies, and it's also going to take longer for the company being audited to produce what they need to produce to the auditors for the requests. And it's one of the reasons they're making the requests. They want to see that things are being done correctly. And when they're not being done correctly. So do you see the nightmare involved in this? If you are a doctor that owns your practice and you're thinking about getting acquired, becoming part of a medical group and having someone manage the financial side of your business, you need to remember this. It is extremely important that you have your act together in your books already. You need to be keeping good books. Hire a bookkeeper and have proper books kept. You know what's even worse in this situation? One of the practices in this situation would not surrender their books. In fact, they would not give us any information. They would send us a backup copy of the books, of the QuickBooks company file, after they finished the month, closed out the month. And you know what? It took them 6 to 8 weeks to close out a month. So we couldn't get financial statements out for at least 2 months, maybe later, because we'd have to go through and fix them to be able to do the financial statements, because they were doing like one journal entry at the end of the month, one journal entry for payroll, one journal entry for the credit card expenses, and one journal entry for all the other expenses. So there's now no detail, no bookkeeping detail at all, just barely enough for tax purposes. And I think that's really all that they were doing. And they were giving that to us to make financial statements from. So obviously there was a lot of work that had to be done to be able to get good financial statements out of that data. Plus, we didn't have access to it until 2 months after. And we were supposed to give the financial statements, like 15 days after the end of the month, which was impossible. So we had to struggle with the doctor, who's one of the co-CEOs, in doing these financial statements, because she wouldn't let us have the books, because she had a relationship with her CPA as such. She did not want to let go of that CPA, and that CPA was keeping tight fist on those books, would not give us access to them. And yet we were so if you're a doctor that's in this kind of situation, if you think that you can hire somebody to do your financial management without giving them access to the books, except, we'll give you reports and you can create the financial statements from them, you're shooting yourself in the foot. I think that this medical group is headed for trouble, because they're not going to be able to get the audited financial statements on time. There are going to be consequences for that, and they're also not changing their ways in how they're keeping the books. The books have continued to be kept that way, and they're trying to make a change, but the doctors won't let them. And so so doing consolidated financial statements, they've had to create a fancy spreadsheet to pull it all together and kind of recategorize everything to make sense on a financial statement, and do a consolidated financial statement to give to the board. And they have to do, that's really complex in itself. And they have to do that in addition to trying to pull together everything that they can from the books. So obviously the financial statements are not going to be accurate. And you need to be giving audited financial statements to the bank. So this medical group is headed for trouble. So don't be one of those medical groups. I mean, one of those medical groups, and don't be one of those practices. When you take on an investor to become part of a medical group, be smart about it. Know that you've got to have your financial pieces together. So, and you've got to give, and if you don't, that's okay, but make sure that you give the experts, the financial people, full access to the books. In fact, they should take over the bookkeeping. They should take over everything. And you should provide them everything that they require. That's the only way you're going to be able to meet the goals that the investors are promising you. They've got to have good, clean financial information. They've got to have good information to make good decisions from. They're going to be making recommendations for your practice. And for those to be good recommendations, they have to have good information. Garbage in, garbage out. That's something I learned from AIT days. In information technology, we're dealing with data. We know that you put bad data in, you're going to get bad data out. It doesn't matter how good your system is. So with all of that, the story, the moral of the story here is you need good books. And if you're having trouble with that, or if you know that you don't have an expert, someone who is a trained bookkeeper or accountant that is keeping your books, if you have your practice manager doing it, you're probably getting in trouble, unless they are an accountant. And most of them aren't. And they're really spending a very fraction of their time doing that. You're going to end up in trouble. Even if you don't get in a medical group, you can be getting yourself in trouble. If you get audited by the IRS and you're going to rely on your CPA, and your CPA is going to have whatever documentation they need, but they may not be completely ready for everything, because you may not have all the documentation that's necessary, especially if not for an IRS audit, because they do require the source documentation. They're actually looking for reasons to disallow deductions from income for tax purposes. And so they'll find any reason they can. So anyway, all of that just to say, I appreciate you're taking the time to listen to this. I know I'm lecturing, but I'm warning you. I'm warning you that you need to be paying attention to this area. You're a doctor. You're expert at what you're doing. You're not an expert in financial matters and financial management of a business. You may have some knowledge of that, but you don't have years of experience of the reality in the real world that you have to deal with when doing bookkeeping and accounting, and being able to read financial statements and making good decisions from them, doing the financial analysis that needs to be done. So, you need to have experts that are doing that. If you need help with that, that's what we do. This is the kind of thing we do. And we, like I'm telling you, a real life story from my experience in dealing with an acquisition with a medical group and trying to help them get their finances together. I was working with hands tied behind my back because the co-CEOs were not cooperating with the financial experts that they had hired to help their practices grow and become more profitable. So understand that. The reason why I'm talking about this, because I care about this so much. I hate to see this happen, and I know how it can affect patients. I know how it's going to affect our healthcare system. If this is pervasive in the healthcare field, we need to fix this. So anyway, don't be one of those doctors. And I appreciate you taking the time to listen. Call me if you need help. You can find my Calendly link somewhere around this video, if it's in the comments or wherever you're watching this. And with that, let's close with a quick prayer. Lord, we thank you for these doctors that have taken time to listen to what I have to say as a financial expert with experience in their industry, and giving them streetwise wisdom about what they're doing in their practices. And just, Lord, I pray that you would give them wisdom, guide them to be good stewards of what you've given them. And we just thank you, Lord, for how you provided for them at this point. And just pray, Lord, that you would continue to provide well for them and provide them the wisdom that they need to be good stewards and for the people that they serve. We lift all this up in Christ's name. Amen.